Segment 2, money. From President Obama and the Obama administration and fiscal policy to Fed Chairman Ben Bernanke and monetary policy. Financial crisis, autumn 2008. From that point, within a relatively few months, the Fed engaged in an unprecedented increase in the money supply. Here's the tightest statement of it I found. This is economist Arthur Laffer. Quote, the percentage increase in the monetary base is this is Art Laffer writing in 2009, is the largest increase in the past 50 years by a factor of 10. It is so far outside the realm of our prior experiential base that historical comparisons are rendered difficult, if not meaningless. Huge liquidity into the economy, and the Fed continues to keep rates so low that mortgages just drop below 5%. Is this the right thing?
Well, I would say two things on that. First, I think that Laffer's statement is a bit of an overstatement in the following sense. First, the Fed has a new instrument available to it, and that is the ability to pay interest on reserves. So a large fraction of the money that was printed is soaked back up into the system, into the Federal Reserve System. That said, I think that this is an issue more for the long run than it is for the short run. And the concern that I have is that when it comes time, and the Fed is already starting to unwind some of the programs that have started, when it comes time for the Fed to unwind, there will be tremendous pressure on the Fed to avoid doing that, in large part because some of the things that it will have to unload, in particular the mortgage-backed securities, will have direct effects on politically very sensitive variables like mortgage interest rates. And so I think that's going to be the pressure in the future. Right now, it's pretty hard to argue that there's strong inflationary pressure in the short run. I think most of the evidence suggests that there isn't. But again, I think the concern is the long run, not the short run.
Mike?
I agree with that. I think we can break this up into 3 episodes. Part 1, some sizable, far from all, but some sizable fraction of the responsibility for the crisis comes from excessively loose monetary policy earlier in the last decade. The economy by 2003 was, in the middle of 2003, was growing at 4.5%. We had a recession in 2001, a slow recovery in 2002. Then the economy started to boom. And the Fed kept its target short-term interest rate, the so-called Fed funds rate, below the rate of inflation for the next 3 years. So what we had was negative real short-term interest rates. So people could borrow $1 and pay it back in 98 cents later. So we had an immense
some
incentive.
extent, the housing bubble is the
housing.
Fed.
It's not just housing. Housing bubble. Low starter teaser rates on mortgages were enabled by this. Home equity lines of credit, auto loans, credit cards and their receivables, private equity, all this stuff was financed. All of this was financed at the short end. People were borrowing short and lending long, making money as long as that continued, as long as strong growth continued and there was a steep yield curve with negative real interest rates or close to zero real interest rates at the short end. Then when that changed and people couldn't continue to borrow short term, that's when things really froze up. That's number one. So they deserve some of the responsibility for the crisis in the first place. That said, the response, lowering rates down to close to zero, and then I think you have to think of it as a series of experiments that they did because they weren't sure exactly what would happen. There was some history in the Depression and some history in Japan in their lost decade with so-called quantitative easing continuing to expand even though you couldn't lower interest rates anymore because they were close to zero or at zero. There was a series of experiments. I think some of them were beneficial, some not. I think it was unfortunate they started to buy long-term treasuries. I think that raises the specter of politicization of the Fed's activities in the future and being unable to unwind. So give them higher marks, good marks for the response. And then, as Eddie said, the real issue is how they unwind. And that's a thing that has beguiled the Fed in the past when they've had to start raising rates early before unemployment got down a lot. There's a lot of pressure on them not to. I know that's Bernanke's intention, but we'll see what happens.
Could I ask you, so layman that I am, I can construct an argument for either worry, inflation or deflation. So the argument for deflation, which you've already touched on, is that there's just so much money sloshing around, it's going to be very hard. The Fed knows how, as a technical matter, to scoop that excess money back, or what will become excess money, but it'll be under intense political pressure to do so slowly, to do so too. So inflation is a problem. On the other hand, mortgage rates are down below 5%. The housing industry is still lagging. Surely that has to be at least in part because people are expecting prices to drop even further. So you could argue, I think, that there are deflationary expectations already built into segments of the economy, and Bernanke is very correct to be worried about that.
I would say this is a short-run versus long-run phenomenon.
Oh,
and
it is.
And again, I think the major problem goes back to what you were talking about earlier. It has to do with our budgetary pressures. So remember where you started. You talked about the very large growth in deficits, the high increase in the debt to GDP ratio. We're talking about something over 70% by the time we hit 2013. Those kinds of numbers mean that the U.S. government will be spending in the very near future more on servicing its debt than it's spending on national defense. And the concern for us, I think, at that point becomes what do we do? Do we start raising taxes and raising taxes dramatically, or do we essentially default on the debt through higher inflation? The U.S. is never going to default on the debt. That's simply not in the picture.
Right, okay.
So the way we would do that would simply be to say, are we going to have a very high rate of inflation and a rate of inflation that essentially renders that debt worth much less to the creditors than it was in the past? And I think that's the big concern.